Hello everyone and welcome back to my channel, where I share with you the best economic advice and information about some of the biggest investors. If you're new here, make sure to subscribe and hit the bell icon so you don't miss any of my future videos. In today's video, I'm going to show you how to invest like Warren Buffett in 2024. Warren Buffett is one of the wealthiest and most successful investors of all time, with a net worth of over $123 billion as of September 2021. He is the chairman and CEO of Berkshire Hathaway, a conglomerate that owns and operates dozens of businesses in various sectors, such as insurance, energy, transportation, consumer goods, and technology. But how did Buffett achieve such extraordinary results? What is his investment strategy and philosophy? And how can you apply his principles to your own portfolio in 2024? That's what we're going to find out in this video, so stay tuned until the end. Buffett follows the value investing approach, which was pioneered by his mentor, Benjamin Graham. Value investing is based on the idea of buying stocks that are undervalued by the market, meaning that their current price is lower than their intrinsic value. The intrinsic value is the true worth of a company based on its earnings, assets, growth potential, and competitive advantage. Value investors aim to buy stocks at a discount and hold them for a long time, until the market recognizes their true value and the price goes up. But how do you find undervalued stocks? How do you estimate their intrinsic value? And how do you know when to buy and sell them? These are some of the questions that Buffett answers with his 4 core tenets, which are divided into 4 categories: business, management, financial measures, and value. Let's take a look at each of them in detail. Business tenets. The first category of Buffett's tenets is about the business itself. Buffett only invests in businesses that he can easily understand and analyze. He avoids complex or speculative industries, such as biotechnology, cryptocurrency, or artificial intelligence, because he believes that they are too risky and unpredictable. Instead, he prefers simple and stable businesses that have a strong and durable competitive advantage, also known as a moat. A moat is something that protects a business from its competitors and allows it to maintain or increase its market share and profitability over time. Some examples of moats are brand loyalty, economies of scale, network effects, patents, or regulatory barriers. Management tenets. The second category of Buffett's tenets is about the management of the business. Buffett looks for managers who are honest, competent, and shareholder-friendly. He evaluates their track record, their vision, and their communication skills. He also checks if they reinvest the profits back into the business to grow it, or if they distribute them to the shareholders in the form of dividends or buybacks. Buffett prefers the latter option because it shows that the managers are confident in the value of the business and want to reward the owners. Buffett also appreciates managers who are transparent and admit their mistakes, rather than hiding them or blaming others. And he likes managers who are innovative and strategic, rather than imitative and reactive. Financial measures tenets. The third category of Buffett's tenets is about the financial performance of the business. Buffett analyzes the financial statements of the company, such as the income statement, the balance sheet, and the cash flow statement, to assess its profitability, efficiency, and growth. He focuses on a few key ratios and metrics, such as the return on equity, ROE, which measures how much profit a company generates with the money invested by the shareholders. Buffett looks for companies with a high and consistent ROE, preferably above 15%. The debt-to-equity ratio, which measures how much debt a company has compared to its equity. Buffett looks for companies with a low debt-to-equity ratio, preferably below 0.5, because it means that they are not over-leveraged and can withstand economic downturns. The profit margin, which measures how much of the revenue a company keeps as profit. Buffett looks for companies with a high and stable profit margin, preferably above 20%, because it means that they have a strong pricing power and can control their costs. The earnings per share, EPS, growth, which measures how much the earnings of a company increase over time. Buffett looks for companies with a high and consistent EPS growth, preferably above 10%, because it means that they have a sustainable competitive advantage and can increase their market share. Value tenets. The fourth and final category of Buffett's tenets is about the value of the business. Buffett compares the market price of the stock to its intrinsic value, which he estimates using two methods, the discounted cash flow (DCF) method and the owner earnings method. The DCF method is based on the idea that the value of a business is equal to the present value of its future cash flows. The owner earnings method is based on the idea that the value of a business is equal to the cash that it can generate for its owners after deducting the capital expenditures. Both methods require making assumptions about the future growth rate, the discount rate, and the terminal value of the business. Buffett uses conservative estimates to avoid overpaying for the stock. Buffett buys a stock only if its market price is significantly lower than its intrinsic value, meaning that it has a high margin of safety. The margin of safety is the difference between the intrinsic value and the market price, expressed as a percentage of the intrinsic value. Buffett looks for stocks with a margin of safety of at least 50%, which means that he pays no more than half of what the business is worth. This way, he reduces his risk and increases his potential return. Buffett sells a stock only if its market price is significantly higher than its intrinsic value, meaning that it has a low margin of safety. The margin of safety is the difference between the market price and the intrinsic value, expressed as a percentage of the market price. Buffett sells a stock if its margin of safety is below 10%, which means that he gets more than 90% of what the business is worth. This way, he locks in his profit and avoids holding overvalued stocks. So, these are the main principles of how to invest like Warren Buffett in 2024. Of course, there is much more to learn from the Oracle of Omaha, but these tenets are a good starting point for anyone who wants to follow his footsteps. If you want to know more about Buffett's investment strategy, I recommend you to read his annual letters to the shareholders of Berkshire Hathaway, which are available for free on their website too. You can also check out some of the books that he recommends, such as The Intelligent Investor by Benjamin Graham, The Essays of Warren Buffett by Lawrence Cunningham, and The Snowball by Alice Schroeder III. I hope you enjoyed this video and learned something new. If you did, please give it a thumbs up and share it with your friends. And don't forget to subscribe and hit the bell icon so you don't miss any of my future videos. Thank you for watching, and I'll see you in the next one. Bye.